I'm originally from Colombia. That's the funny accent. I actually had better English until I moved to Miami. Uh, and so we started buying houses in 2009 in the middle of what I think is probably one of the meltdowns, the biggest real estate meltdowns that we ever seen over the last 20 years, of course. And it was hard because back then, just to give you a frame, sort of analysis of what was going there, people were scared. People didn't want to buy anything. I mean, we were buying one house and we were getting calls from brokers and saying, we just realized you bought one house, you buy 20 more. We were going to investors and saying, hey, we think this is a great opportunity. We're buying a house, we're fixing it, we're renting it to the government, Section 8. The government is going to pay your rent. It's going to be a 12% cap rate. Will you buy a bunch of more, a bunch more? And they said no. And by the way, this is not a fund. You know, you're buying the property in your name, in your title. It's yours. You rent it. You know, we'll do everything in the back for you. No, it was bad. Uh, you know, it was very dark and there was no light at the end of the tunnel. In 2009, actually 2008, we decided that this was a great opportunity. We saw the opportunity coming. Uh, Actually, I saw the thing coming in 2005, and I started preparing for it. So when 2008 was finally here, I created a company with my partner Jimmy. He had a couple of franchises of We Buy Ugly Houses, and he had sold and flipped about 600 homes, and he had already, you know, lost it all because obviously the inventory he had melted down. And we sat down and we had a plan. The plan was to create a company to buy houses to create cash flow, and we believe cash flow was key. The cow is worth the milk it gives, and somehow that was very important for us, especially because at that moment nobody in their right mind will think about speculation or price increases. So PIA was born, Property Investment Advisors. We bought our first house in 2009, and it was sort of the divisions were clear. I'm the guys who goes out and try to get the houses, and Jimmy was in the back end, providing all the support and coordinating everything. And slowly but surely we started creating a platform. And the first thing that we did is, after the third house, we realized that property management needed to be brought in house. It was a necessary evil, but we needed to do it. Then we created our construction company and then a property maintenance company. And before we knew it, we had a vertically integrated platform. We actually invested about $500,000 in software, right, to create what was back then, very specialized software, because nothing was done in the single family industry was not even born. We were seen as a bunch of cowboys. A friend of mine thought I was crazy. I almost got killed twice by looking at houses. I saw 6,000 homes to buy 400, not in the best neighborhoods. And so as we started moving through this, we realized that there was a very large opportunity, and we started attracting some sort of, more institutional capital. At some point, Blackstone, the guys from Invitation Home, came to our office, and eventually we set out with a family office that basically gave us money and created runway for us to grow the platform. And I can tell you, there's a lot of lessons to be learned when you start from scratch from one, right? And we were very operational. I mean, we were collecting rents, we were evicting people, we were, construction, everything. We were doing everything. And there's the good, the bad, and the ugly about that, right? So how did we do that? The lessons learned, and how this is applied today to the very tight environment of residential real estate, especially multifamily, is what I want to convey today in this presentation. So the slides you're gonna get, you can request it from Flyer, and we're gonna send you a link to the slides. But basically, one of the things that we did in about 2016 is, we started analyzing. We always analyzed. We always had a framework of analysis, an economic framework, and that economic framework was basically the three legs of the stool, as I call them, which is, one is replacement cost, the other one is your spread from your cost of capital to your cap rate, and the third one being an economic value of the property. An economic value, it's defined as, for me, is if you take a rent payment and convert it into a mortgage, how much of that mortgage basically justifies the value of the house. Of the rent payment justifies the value of the house. To give you an example, if a rent payment justifies, let's say $200,000 mortgage, and the house trades for 150,000, then you can sort of say that it still has runway, it still has ways to go before it catches up. But if the inverse happens, then you said, well, we might be in a bubble. So it's a great reference to look at things from the perspective of the value creation. Again, we're investors. We invest in cash flow. We invest in solid things. And for us, it's very important to have that framework and that analysis. So in that analysis, 2016, we more or less start seeing that the curve of replacement cost and the curve of economic value and the curve of cost of capital versus cap rate were almost just getting to a point we were not feeling comfortable with. And we said, you know what, maybe we got about 2 more years worth of runway. What do we need to do to prepare our portfolio to be sold in about 2 years? But most important, what do we need to do as a company to pivot from single family to what, right? And that was the first question we answered. Is like, we feel strongly about residential. We believe residential is the core basis of the family. They have to live somewhere, so it's a need. And we saw how when the economy just basically hit the fan, people still paid rents. So properties went from about $300,000 to like $70,000. At least in Miami, we bought a couple that that were worth $300,000, and the rents for 70,000. I'm sorry, and the rents just basically drop a little bit from 1,500 to 1,400. So the elasticity between the rents and the price made us very, very aware that rental residential is a key asset in order to sort of weather any storms. Right, and storms will come because economies work in cycles. So we sat down and we analyzed and we said, you know what, multifamily is the place to be. We have a lot of knowledge and know-how and know-who in this industry. We'll stay here. Certainly, there were other asset classes that were sort of more interesting, less work, right? But we decided that we wanted to go with multifamily workforce housing, and this time we really sort of sat down and thought about the whole platform. And we said, there's a lot of knowledge in the industry about multifamily, and we hired people that brought that knowledge with them. We couldn't do that in single family because, nobody knew about how to institutionalize single family. So long story short, we ended up selling our portfolio in 2018. We created a platform to allow other investors to invest with us in multifamily. And since then, we have been, sort of growing our platform very carefully. We want to make sure that we're building something that is long lasting, not for the next 3-5 years, but looking at this as a 20-30 years horizon. And for that, we brought a lot of experience. We analyzed that. We ended up buying our first building in 2019. And then after that, after analyzing about 500 properties, we bought our second building in 2020. And they're performing great. We bought one in Pensacola and one in Jacksonville, and we're right now looking at 3 or other 4 opportunities. So going back to it, what was it that we really learned? The first thing is hindsight is always 2020, right? People told me, oh, you know what, it was easy for you guys, buying houses, it was easy. It wasn't easy. It was hard. Again, I said it, we had to go and build things from scratch, right? And the first thing is that you have to have a guiding principle. And that guiding principle is the way we did things. And the way we did things is that we recognized that people were important, that processes were important, right? That operations were important. We basically became highly operational on these things, right? And we also recognized that going the institutional way long-term was the more efficient way. It was very expensive. You have to have a CFO, you have to have processes, you have to have all this organization behind it. And from some guys that are starting from, buying 1 or 2 houses to start thinking about institutionalizing that, it was great. Then, we had the fortune that our partner Saul joined us about a year after we started this platform. And then, it has been an amazing ride. So we sold our portfolio, right? As I mentioned to you, we sold this portfolio not because the opportunity presented itself, is because we did the deep analysis and we believe that holding the portfolio was no longer worth it after 2018, and we got a really good offer, right? And I remember 2018, we did this stochastic model to try to figure out whether she'll keep on holding the properties or not. And, I basically sort of got to the conclusion that we had about a 10% chance that the prices will increase by another 10 or 15% in 2019, and definitely very little chance in 2020, right? Hindsight is 2020. But again, the economic theory and the economic thesis for that increase was not there back then. I think that very few people can actually predict what we're seeing right now. Okay, so again, goes back to that we went back to our economic model and the framework, and we said, how do we analyze this thing? How do we perceive the risks are? What are the upside? And we're very data oriented, because when you're playing with millions of dollars, you just cannot go by gut. It is important, the gut. Experience is important. That's why we hire people with, white hair, no hair, right? Or the combination of both. But, that experience, allows us to make the conclusions that we get to. So in sort of the migration from, buying one house to having up to 400 small multifamily doors and and another 400 single families, to let's pivot to buy multifamily, there's a lot of things that you sort of start realizing, oh boy, I would have done that before, right? And so those lessons are a key part of what we are today as PIA Residential, which PIA Group, which was the company was doing houses, turned into PIA Residential, right? And so we go back to what we've seen before and what is the current environment, and it's current environment is worrying, right? You see that there's a lot of frothiness in the market. There's a lot of smart money coming to multifamily, especially workforce housing, which is great, right? There's a lot of competition to win deals. I do believe that smart money, basically, it's coming because they're getting away from the, I will say, the business, the office buildings and the commercial strip centers and the hotels, because they're realizing that those type of assets will definitely be disrupted, and they feel like workforce housing is here to stay, and therefore has less volatility. So as we measure risk with volatility, I believe cap rates will tend to compress. And most important, everybody's back of the mind, which is inflation. Inflation's coming, no doubt about it, and residential rent is a great way of protecting an inflation, because you got, even though you have 12-month cycles and multifamilies, right? You have people reconverting, renewing the rent, the contract every month, right? So I think that it's a great way to hedge against inflation, and equally important to hedge against the disruption that will happen in real estate. I actually encourage you to go to Futurology. I have a link later in the presentation where I talk about how real estate is going to be impacted by changes in technology, right? So the other things that we started looking at in PIA is, how do we take advantage of our knowledge, right? And how do we structure this? So we started by structuring special purpose vehicles. And, because right now it's very sort of hard to create a pipeline of, good properties to buy. We were encouraged by some of our investors to create a fund, and we're launching that fund in a couple of weeks, and also encouraged by some of our investors to create a hard money lending fund. And the idea of the hard money lending fund is that we're basically using the connections that we have in our knowledge to deploy this money in the hard money lending space, especially in multifamily and fix and flip loans and single family loans, right? So what we learn that it's very important is you have to stay true to the fundamentals, right? Pushing the envelope, can only result in pushing more the envelope, and before you know it, there's no envelope, right? So we started when we were buying single families literally with no box, just buy, right? They're just cheap enough, there's no box. And as the industry starting evolving, we needed to create boxes, and we got money, then we needed to create guidelines. And so we went from having no box to having a box, and right now we have a strict box of what we think is the conservative way of deploying that money, right? So we do understand that the opportunity sometimes is you look a little bit beyond the box, but it has to be done with a framework in mind. And what we did with the little bit beyond the box is we started looking at secondary and tertiary cities, because we believe that those cities is where ultimately you will find value. Uh, you know, that's why when we invested in Pensacola, and nobody actually, it was my first time, actually second time in Pensacola, and when I was trying to raise the capital for Pensacola, a lot of people didn't know where that existed. But you know what? It's a great city with a great dynamic, and the COVID crisis proved that being close to military markets, it's a great idea. It's not about strategy, and for us it created a great result, right? So the other thing that we really understand is that it is important to have a good capital stack and never put that capital stack at risk. So we're shying away from financial engineering. And a lot of people talk about IRRs and cap rates. I actually have an article about what when an IRR is, I'm sorry, when a cap rate is not a cap rate, and coming one with what is really through an IRR. And a lot of people are looking at these opportunities and they say, oh, it's a great IRR. They're not measuring the risk. There's a lot of financial engineering being done right now, and you have to be very careful with that, right? One of the things that we learned early on in single family is that we didn't know what the future held. So, we were using low leverage. Again, it was very hard to get leverage, but we're using low leverage and non-recourse leverage, right? And that gave us basically the ability to grow the firm very quickly, because we didn't have to come, and create financial responsibilities for the people who are investing with us, right? So one of the other things that we really learn about this experience is the difference that it's being highly operating with almost 800 doors, individual doors in a way, to having a sort of platform, equity platform. And one was very operational, and the other one is just very strategic, right? So we had to create the tools, we had to create the people. We had 80 people working here. This was a soap opera and a reality show combined at some point. Just imagine collecting rent, having tenants come here, evicting people, dealing with the construction crew, then with the maintenance crew, to basically having desks, right? And having properties that are managed by amazing property management companies that we asset manage, right? And so one of the things that that it's core to our belief is that we bring a lot of baggage from managing and being in the property management and construction business of the houses. And perhaps one of the mistakes that we did there is that we got too involved and consumed a lot of bandwidth, right? But you know what? At the end, we took the knowledge from that, and now we parlaying that into multifamily. And people asked us, but if you guys property manage, why don't you property manage your own properties? And we said that we want to be as far away from that as possible, because we will never be as good as a property manager when those property managers have 10,000, 20,000, 50,000 units. And equally important, if I'm going to buy in a market that I've never been there, I want to be able to do it the best property manager there. A lot of people bring us opportunities because by not being a property manager, we have property managers that bring us opportunities. So you need to be a very good asset manager. And that's where the key of multifamily is, right? Property managers are good as they are. They need to be asset managed. And when they call me up and they said, well, you know what, we need to change an air conditioner, it costs $300. I'm like, no, I know it costs 100, right? Or whatever the number is. And we know who to call, and we know what that framework is. And we push the envelope to make sure that things get done for the prices that we believe are fair. Again, there's a lot of cheap things that at the end are expensive. And we know the balance between both of those, right? We started single family houses, we started installing used air conditioning units. And then we realized that at the end, it didn't work that well. We ended up paying for a cheap brand, new brand that didn't work that well. And then you went with the regular brand and you have less headaches. So for us, that was important. To make that sort of pivot from being property managers to asset managers. Current state of multifamily, I guess a lot of people already talked about it. I think I have 5 more minutes, so I'm gonna skip through this one. But you know what? There's cap rate compression. Everybody's looking for this, right? It's an interesting asset class to be in. We're geared more towards high net worth individuals and family offices. And, we're starting to have conversations with institutional capital that are very attracted to the way we do things. It's entrepreneurial yet institutional. They're attracted to our story. They're attracted because we know what we're doing. We've actually have the scars to prove it. And so, in our way of doing things, we've discovered that we're very, very good at, the approach of value added, light value added, and how to manage risk. So I want to talk about basically the key lessons learned. And, I believe that there's way of saying things that people will remember them. So I try to put it here in what my, the lessons that I think. The cow is worth the milk it gives. Basically, it's cash flow, right? If a cow is not worth the milk it gives, then it's a pet. I have a dog. It's a pet. It's very expensive, right? So, wait, hold on. All right, somehow that got screwed because all right, I don't know. Okay. So this part here, the cosworth gives this part here, it should be under another bullet point. Sorry about that mistake, right? But it's important to have a framework, and our framework basically it's cash flow. Cash flow is king, right? Appreciation and speculation, and we move it forward, right? The importance of having a word, right? Your word is your bond. Relationships matter, right? And not only that is important for your investors, but equally important for your brokers and your bankers, because they are the ones who make the business happen, right? They will not bring you opportunities if you're always retrading, right? And the bankers, they will not give you loans if you are not structured and you don't give them deals, right? So it is important to sort of abide by this code of ethics that in the industry, not a lot of people have them, right? I mean, retrading is very common. We don't do that, right? We have very good relationships with banks or brokers, and we're equity partners. Experience and God is not taught in Ivy Leagues. A lot of people say, oh, have this great, amazing, team. They've been doing that for the last 3 years. No, we brought people in here that have been here for the last 2 or 3 economic cycles. People with no hair, gray hair, right? We walk the neighborhoods, we smell the neighborhoods, we talk to the people who are there, right? We understand in how to sort of gauge the risk that is there. And again, we're in residential real estate. You have to pose as a resident, see how you get treated. All those things we know how to do, and we've been very successful at it to identify, certain risks that are not measurable, that are not given to you in a Yardi report, right? Those things, the sort of boots on the ground, it's what makes it happen, right? As I say, boots on the ground and not Gucci's on the floor. It's important. You have to walk it. You have to walk it, right? The reality show of property management. This is a conversation I had many times. I'd rather be an asset manager than a property manager, right? I've been through that. Sometimes property management, becomes this reality show that we had, and it consumes you, right? We have to let the property managers do what they do best. And if they don't do it well, then you fire them, you get somebody else who can do it better. And by not having the property manager yourself, you're allowed that flexibility. But equally important and is, for the investors to know that you're not committed to a single property management company. It gives them ease that, when a property is mismanaged, you have no problem in changing your property management company. From having no box to being inside the box, right? The institutionalization of the platform for those you guys who are, starting up, it's not cheap, but it's important, because becoming corporate brings you not only more structure, but it brings you this economies of scale, right? Now you have to pay all these people that are high salaries, CFOs and accountants and VP of this and VP of that. But guess what? That institutionalization of your platform allows you to access cheaper capital, better capital, more abundant capital. So don't think of oh, it's expensive to institutionalize. I will tell you that it's the only path to move forward, right? And this one's cool one because we missed a lot of opportunities because we were just basically, you know, average people sitting in, you know, this office going to buy houses, and we never saw things with different eyes, right? I was the head of acquisitions. The people I got surrounded by people like me. Wrong. You have to be as diverse as possible, right? If you follow the arts and the yoga mats, you would have been able to, you know, really understand how Wynwood was formed and all those other neighborhoods that actually came out of nowhere, gentrified, and you know that's where the properties sort of went from 100 to a million very quickly. So surround yourself with diversity uh, because it's profitable, right? Having diverse opinions is profitable, right? People who understand things different than you, it is important. Okay. And I think that that's, you know, one of the things that I will always take myself, you know, in the future is my team has to be people who are not like me. Last but not
Danny,
least, yes.
we're out of time.
Okay.
If you want to do just a quick summary and closing
Uh,
comments.
yes, guys, listen, at the end, you know, multifamily platforms, when you're evaluating where to invest or how to invest, you know, make sure what the experience of the principals is and that they have, I will say, a lot of operational experience. A lot of operational experience that they actually have walked the neighborhoods or they know how to handle situations when they come up because at some point the economy is going to get ugly, and when it gets ugly you want to be behind those guys because those are the type of guys like us who know what to do when, you know, it hits the fan, right? We, you know, if somebody tomorrow calls me up and say I don't want to manage this building anymore, have it, I know exactly what to do, right? So, you know, when you're looking at the asset class of multifamily, it's not only the asset, but it's the people that you're investing with that's important.
Danny, thank you so much for your presentation today.
You're
And
very welcome.
thank you for being a good friend.
And thank you very much for
Uh,
everybody for listening to me and have a healthy, you know, week.